Ms. Bowman, you have the next presentation introduction also.
Yes, sir. Josh McLaughlin from BOK Financial is here to do a presentation regarding our first bond issuance of the 2018 bond election.
Good evening, Dr. Brown, President Davis, members of the board. It's a pleasure to see you again. Let me first start out and say congratulations. You did the hard part. You passed the election. This is really the easy part, which is selling the first installment of bonds. Actually, before we talk about selling the new bonds, let's talk about how you've managed your debt portfolio. We've seen this before, but I always like to point this out every time I come speak publicly, which is how the district has saved taxpayers' money. Every year, the district actively manages its debt portfolio by refinancing its existing bonds at a lower interest rate or prepaying bonds prior to final maturity. The combination of both the last 7 years has generated over $29.4 million of savings to taxpayers. Oops. Okay, I'm terrible at this. Mark, I'm just going to point to you. Fair enough. This is a summary of your existing debt portfolio as it's currently structured. Currently, you have just over $253 million of bonds outstanding. Your bonds are repaid over a 21-year period. Typically, when the district goes out and sells bonds, it does so over a 25-year period. You have $9 million left from your 2014 bond program. You're currently rated AA2, AA, and AA plus from Moody's, S&P, and Fitch, which are outstanding ratings. But as a reminder, when we sell bonds, we will do so with the permanent school fund guarantee, which gives you an automatic AAA rating, which is the highest available when you sell your bonds. But if you look at the structure of your bonds, you can see how your bond payments decline over time. That is one of the main reasons, besides your value growth, that you can sell the 2018 bond program with no tax rate increase. This is a look of current investment rates. This is what's known as the bond buyer index. It just gives you a general indication of what municipal interest rates are doing. And if you could look at them for the last month, you see interest rates are dropping. A lot of this is due to the economy. Investors are worried about the Federal Reserve maybe increasing rates too much and the economy slowing. So we have what's known as the flight to quality, and everybody runs to bonds. Also, due to the lack of issuance in the municipal market, interest rates have remained low and demand for school district bonds remains strong. So at this point in time, normally we would come present the financing plan tonight and then come back to you in January to ask you to adopt a parameters order. We're doing everything tonight to try to take advantage of these low interest rates by getting to market as quickly as possible. The goals of the financing plan. The first goal is to meet or exceed the expectation of taxpayers, which basically means, in this case, taxpayers were promised the bond program would be sold with no tax rate increase, and indeed that will be done with no tax rate increase. We also want to design the bond program so you have future capacity for capital improvements. The bonds will be repaid over a 25-year period or less. Short-term projects, we are not amortizing computers or repaying computers over a 25-year basis. Those will be paid over their useful life. So for devices, it's 5 years. Infrastructure, it's 10 years. We want to make sure we provide ongoing flexibility to prepay your bonds. Our financing plan is based upon conservative assumptions, so if things come better, we want you to have the ability to annually manage that tax rate and debt portfolio. And the last thing is we want to structure the bonds in your program so you comply with the state-mandated 50-cent test and issue no capital appreciation bonds. On page 5, this is a summary of the projects you've seen within the 2018 bond program. Based upon the cash flow provided, we will look at 3 distinct sales. The first one would be February of this year, followed by one the next couple years in March of each year. But for the 2008 bond program or 18 bond program, $155 million, $69 million, and then $28 million to round it out. All right, so what we plan on is taking the 155 from your 2018 bond program and adding the additional 9 from your 2014 bond program and issuing $164 million of fixed rate bonds this February. The timing of the remaining sales, again, subject to change, but we're planning a $69.6 million bond sale in March of next year, and then in March of 2021 we'll complete the 2018 bond program with a roughly a $28 million sale. All of the bonds are being sold with fixed rates. We're not introducing variable rates within the district's bond portfolio at this point in time. Assumptions, again, the bonds will be sold without increasing your INS tax rate. The estimated interest rates are as follows. The 2019 bonds, we're projecting an interest rate of 4.11. Okay, that does have some conservatism in that number. If we sold bonds today, that number would be less than 4%. Again, next year we're assuming 5.25, and the final sale 5.50. Again, because we think interest rates will increase over time, and we want to be conservative. Again, the 2019 bonds will be sold with a 25-year amortization, but they'll be structured so you could prepay those bonds prior to final maturity. The district will have $5 million to use from its existing fund balance to help subsidize the INS tax rate. Whether the district will actually need to use that money or not will be a function of how your value grows over the next couple of years. And finally, you will not receive any state assistance for the repayment of bonds. Go ahead. In terms of your historical value, Mark, you just see a couple more. Currently, your values are roughly $9.1 billion net of frozen. If you look, this past year you grew $736 million. The maximum occurred in 2017-18, which was an increase of over $940 million. But if you look at what's happened on average over the last 10 years, you've grown at roughly a $226 million clip per year. For the purposes of this financing plan, we're assuming that you will grow at that same $226 million clip on an annual basis for 4 years and 4 years only. The reason we're only using 4 years is we want future value growth to pay for future bond programs. So again, another conservatism measure. This has a lot of numbers, but at the end of the day, if we look at the last 5 years, you've grown on average around $490 million, or roughly 6.45%. Based upon the assumed value growth, you're going to grow at $226 million, or just over 2.4%. So again, trying to be conservative. At the end of the day, based upon the current projected results, you would be able to sell your entire bond program, maintain that 41.39 cent INS tax rate, based upon a 4.11% interest rate on your 2019 bonds. Your net projected payments are roughly $444 million, which is roughly $25 million less than the financing plan used to communicate the cost to taxpayers at the time of election. In terms of bonds being repaid over the next 5, 10, and 15 years, in the next 5 years, it's going to be $32 million, $68 million over the next 10, and almost $120 million over the next 15. Again, we're paying for the short-term assets over their useful life, and the final maturity, again, will be February of 2044. One of the things I did want to point out on this page is, again, your bonds will be sold and you will have the ability to prepay those bonds prior to final maturity, but a portion of this upcoming issue will be sold with a short call mechanism, meaning a portion of these bonds, roughly $22 million, will be sold with a 2-year call feature. This will allow the district to start to prepay bonds, assuming its values grow more than what we've projected. Finally, later on in the agenda tonight, we're asking you to adopt a parameters order. This will allow the district's administration to move forward with the sale of the bonds subject to these parameters. We can sell no more than $164 million. The interest rate cannot exceed 5%. The final maturity, again, cannot exceed 25 years. And we have to get this all done in the next 180 days. The reality is we're trying to get it done in the next 60 days to take advantage of interest rates. Unless we can accomplish all these parameters, we cannot move forward with the sale of the bonds. In terms of timetable, we're here tonight to get authorization to move forward. We would anticipate having everything wrapped up by January 4th and to be in a position to price the bonds either the second or third week in January. Subject to those pricing dates, the district would receive its funds on February 7th. I know I went through that relatively quickly. I'll be happy to answer any questions you have.
Any questions? Mr. McCarty.
So first, I want to say to the rest of the board and those that have come before us, I think been extremely good stewards. So we were always handed something really good, and I think we should make sure that we continue to hand that forward in the future as well. And thank you for the presentation. When you look at selling on the short-term bonds, so like a 2-year window, and the long, are the interest rates? I mean, it's hard to say where interest rates are going, so I don't know whether they're going up or down when you sell short-term or long-term anymore. But are the interest rates effectively the same, or are they different?
Between short-term interest rates and long-term interest rates?
Yeah, selling those two-year bonds versus the 25-year or whatever.
So depending upon the structure of those bonds, the interest rates aren't dramatically different as long as we use the correct couponing mechanism. The penalty for having a 2-year call versus, let's say, a 9-year call is minimal.
Okay. I was just curious because used to in the past there was a pretty big penalty.
It was, and if we were using a coupon of, let's say, 5%, that cost would be dramatic. We are planning to use a discount structure on those particular bonds, and based upon that, the penalty is actually very minimal. Somewhere between 5 to 10 basis points is what we're currently calculating. And again, that's only on a very small portion of the overall portfolio.
Other questions for Josh? Thank you very much. Look forward to some good news the first couple of weeks in January then.
Thank you, sir.